You spent 3 weeks researching the price, you walked onto the lot with a number in your head, you held the line for 2 hours, and you won. Then someone shook your hand, walked you down a short hallway, and sat you in a small office with a desk, a computer, and a folder. In the 40 minutes you spent in that room, the dealership made more money off you than it made selling you the car. That is not a figure of speech. It is printed in the financial statements the biggest dealership chains file with the government every 3 months. So, what actually happens in that room? $2,381. That is the gross profit AutoNation booked on the average new vehicle it sold in the second quarter of 2026. AutoNation is one of the largest car dealership groups in the country, and because it is publicly traded, it has to publish these numbers line by line every quarter. Gross profit is a simple idea. So it is what is left of the sale price after you subtract what the thing cost you here. That means what the dealership paid the manufacturer for the car. So run the arithmetic on the average new vehicle AutoNation sold. It left the lot at about $52,000. The dealership kept about 2,400 of that, a margin of 4.6%. That is grocery store territory. And that is not one company having a bad quarter. Across more than 4,000 dealerships tracked by the Presidio Group and NCM Associates, gross profit on the average new vehicle fell more than 13% in a year to about $1,840. Now, the second number, $2,799. That is what the same company made per vehicle in the same quarter in one department. Not from the car, from finance and insurance. The F&I office, the room at the end of the hallway, so on the average car, the hallway beat the showroom, and that is the small version of it. Add up the whole quarter, and the finance office produced more gross profit than new car sales and used car sales combined. $358 million dollars from finance and insurance against $151 million from new cars and $115 million from used ones. Across the first half of that year, new vehicles were 47% of that company's revenue and 12% of its gross profit. Finance and insurance was 5% of revenue and 29% of gross profit. You spent 3 weeks preparing for a fight over 4.6%. The finance office is not a formality and it is not paperwork. It is a sales floor and it sells three things. Only one of them is obvious. The first is the loan. When you finance at the dealership is not lending you the money. It sends your application to banks, credit unions, and the manufacturer's own lending arm, and one of them comes back with a number called the buy rate. That is the rate the lender will actually accept. What happens next is the entire business. The dealership is allowed to quote you a higher rate than the buy rate, and it keeps a share of the difference. In the trade, that is called dealer reserve. Lenders usually cap it a point or two, sometimes three. One extra point on a $44,000 loan stretched over 7 years is roughly $1,000, moved quietly from you to the dealership for no additional work. You will not see a line for it on the contract. There is no line for it. It is inside the rate. The second thing the office sells is products, the service contract, the gap coverage, tire and wheel, paint protection. Key replacement and the clearest description of how that works comes from the dealer's own filing. The money, it says, is commissions earned for placing loans and leases with third-party financial institutions and for placing vehicle service contracts and other protection products with third-party providers. Then it adds one more thing. The company also participates in the future underwriting profit on certain products. Read that twice. They are paid when you buy the product. And they are paid again out of whatever is left over if you never use it. The third thing that office sells is the one nobody notices, because it is not a product at all. It is the term. How long is your car loan? A record 23.9% of people who financed a new vehicle in the spring of 2026 signed up for 84 months or longer. 7 years, stretching a loan does not make anything cheaper. It makes the monthly payment smaller, and a smaller payment creates room. Room to add a $2,000 service contract and watch the payment rise by $28 a month, which does not feel like $2,000. It feels like nothing. The Federal Trade Commission has a name for the aggressive version of this. It calls it payment packing. You get talked into a monthly payment larger than the price you negotiated actually requires, and the gap gets filled with add-ons. It sits at the center of an enforcement case the agency has brought against a large dealership group still pending and undecided. And the reason that room is worth so much is buried in the accounting. On the income statement, the finance and insurance line has revenue and no cost of sales at all. None. The line literally reads revenue and gross profit. because they are the same number. There is no metal to buy, no inventory to finance, no trade in to recondition. Every dollar that room brings in arrives as profit. If you like having this stuff taken apart for you, that is the entire channel. One everyday thing, decoded every week. So, what does it cost you? In that same quarter, the average new vehicle buyer financed about $44,000 at 7% and walked out with a payment of $777 a month, a record. Over the life of that loan, they will pay $9,811 in interest. Also a record. And this is where a long term quietly turns into a trap. Almost 30% of trade ins on new vehicle purchases that quarter were worth less than the loan still owed on them. The average shortfall was about $6,900, and it does not disappear. It gets rolled into the next loan. Those buyers average $944 a month and are on track to pay more than $16,000 in interest on one car. One more thing worth noticing right now: the Federal Reserve has held its benchmark rate steady for 5 meetings running at the lowest level since late 2022. The average new car loan is still sitting around 7%. The rate you are offered is not the Fed's rate, it is a lender's rate, plus whatever the finance office decided to add. None of which means you should be afraid of that room. It means you should treat it as the second negotiation and walk in prepared, because it is the one that is actually worth money. 4 things. Get a real loan approval from your own bank or credit union before you go, not a rough idea, an actual rate so you arrive with a number to beat. Second, when the dealer offers to beat it, ask what the buy rate is and whether your rate has been marked up. You may not get a straight answer. Asking still changes the conversation. Third, treat every product as optional and separately priced, because it is, and most can be bought later or canceled afterward for a prorated refund. Fourth, negotiate the out the door price, never the monthly payment. And you have more standing than you think. In 2026, the Federal Trade Commission warned 97 dealership groups that an advertised price has to be the total price, including every mandatory fee. A dedicated car buying rule that would have spelled that out was struck down in court and has since been taken off the books. But the older ban on deceptive advertising is still there, and the agency is still using it. So the next time someone tells you a car dealership makes its money selling cars, you will know the real shape of it. Selling you the car earns them about 4 cents on the dollar. Arranging the loan for the car you already agreed to buy earns them a quarter of everything. The showroom is the doorway, the hallway is the business, which reframes the whole afternoon. The hours you spent grinding over the sticker price were not the negotiation, they were the qualifying round, and you were being walked toward the part that actually pays. None of this makes anybody a villain. It is simply where the margin went, and it is sitting in a public document anyone can open, which means the room at the end of the hallway only has power while you still think it is paperwork. There is a new one of these every week, and Penny is already working on the next. And if you want to see the same move in a completely different industry, go watch Delta made more from Amex than from flying you. An airline that earns more selling miles to a bank than selling you a seat is the same story as a dealership that earns more arranging your loan than selling you the car. Both quietly move the profit into the part you were not watching.